You're the EM guy. What do you do with this sell-off? Do you sell into it, or do you look for value?
Look for value, definitely. I mean, we've seen so many of these markets bombed out. There's tremendous opportunities. I'm not saying you jump in with 2 feet, but at least you begin to stock pick. I mean, the beautiful thing about these situations is that there are always going to be winners and losers. Even if the Chinese situation gets worse with this trade war and Trump imposes this 25% tariffs, there'll be winners in China, and we've got to look for those.
So where would you be looking to buy? Because as I mentioned before, this is the worst sell-off peak to trough we've seen since 2008. And you have to wonder if it's going to be in FX, if it's going to be in bonds, if it's going to be equities, and what country specifics, Mark?
Well, definitely equities. Those are the things that have really been hit hard, with few exceptions. Of course, bonds in Argentina and a few other places like Turkey have been bombed out as well. But we think equities are the place to be. And the countries, we've been just putting together a model portfolio for our new funds. And Brazil figures in very highly in that. India, of course, is very big. Korea is in there. Those are the big ones at this stage of the game. But then along the sideways, we see things like Russia, opportunities in Argentina, opportunities in South Africa, and so forth. So there are lots of interesting things happening in these countries. And you got to remember that individual companies is where you got to focus, because a lot of individual companies are going to benefit from this kind of volatility that we've been seeing.
So, Mark, if there is going to be a turn in EM, and we're looking right now at a chart showing what's happening with currencies and stocks as well, where's it going to come from? Because isn't there a tightening of the Fed that's helping drive this? Isn't there a problem with the trade, as you referred to it, that continues even today? So what's going to turn it around?
Well, I think, first of all, you're going to see a devaluation of the renminbi. I mean, if you're sitting in Beijing and you have a 25% tariff being put into your on your goods going into America, the best defense would be to devalue your currency by that amount. So we could be seeing as much as 8 renminbi to $1. I mean, it's not beyond the possibility.
Well, Mark,
so I think this is the kind of thing you've got to watch for.
Mark, if we see 8 renminbi to the dollar, I can't imagine that global markets aren't going to just be taken out to the woodshed of that. That reminds me of an August 2015 kind of scenario.
Oh, there's no question there'll be a lot of blood on the street. But don't remember, there are some countries that have very strong balance sheets. Look at what's happening in Thailand. Thailand, baht has held up very nicely. So, yes, it is true that if China devalues by that amount, there are going to be a lot of losers. But also winners. You must remember that there's that possibility.
So, Brian Belski, what's your view on this? Have we bottomed out, or are we about to bottom out, or is there going to be a lot of blood on the street, as Mark just said?
Well, my question for Mark would be, Mark, excluding currency, we all know about currency. So if you take a currency discount and then you actually really look at fundamentals, how do you know that you can, will, and should be avoiding a value trap? There's a price, there's a numerator and denominator. Where can we believe in the denominator in terms of book value, cash flow, and earnings? And when does that switch kind of take place that you can actually believe in those values?
Well, we can believe in these values if, number one, the balance sheet of the company you're looking at is strong. I mean, that's just the key factor that we're looking at this stage of the game. 2, let's look at those companies that have an earnings potential. They're in an industry that is growing in any case, and they're in a consumer-oriented scenario where the consumers are still buying. Despite the fact that you have a devaluing currency, you still have the domestic market that's doing quite well in a lot of these countries. So I would say those are the 2 things we would look at. And if you look at our model portfolio, you'll see that consumer goods are really at the top of the list. Discretionary consumer goods are really up there, and that's what we're looking at now.
Okay, so basically what you're saying is avoid kind of the noise here near term on kind of the overall emerging market theme for the world and focus more on the domestic side as emerging markets kind of transition from this industrial-based machine from growth the last 15 years into more consumption. Is that kind of the right way to think about this, at least for one theme?
Exactly. That's precisely it. The consumer is king now in these countries, and they're going to get richer and richer, and they'll be buying more and more going forward.
Mark, to what extent should we be concerned, paying attention to the increasing divergence between the United States and the rest of the world? By the way, that's not just emerging markets, for that matter, Europe as well. Can that continue, or is there some reversion to the mean here?
No, there's no question that, what's happening in the U.S. is having a tremendous impact, and interest rates are the key. I mean, with the Fed raising interest rates, and of course that's going to continue going on as the American economy booms and as unemployment goes down and the fears of inflation increase. So all of these emerging market currencies are going to have to be devalued. They've already happened, but you'll see more of that. But more importantly, you're going to see these countries being forced to raise interest rates, which will put a brake on the devaluation of their currencies. But that's going to happen. And of course, those people that are heavily in debt are going to be in real trouble in these countries. I'm talking about not only foreign debt, but domestic debt.
Yeah, in theory, right? I mean, Argentina raising rates, we're at 600 basis points now, but yet that hasn't stemmed that slide in the peso. So I have a double-pronged question for you, Mark. One, is the sell-off over? And if not, what's going to be the next emerging market currency to fall as we've gone from Turkey, Argentina, Brazil, now we're at the Philippine peso?
At this stage of the game, I think if you look at South Africa, you'll probably see more weakness there because, the economy has slowed down quite a lot. A number of these African countries, of course, will see their currencies drop because people are going to want to buy U.S. dollars or euro. And in some of the East European countries, you may see some devaluation. But I would say the big devaluations have already taken place. And now it's going to be incremental, maybe 10, 15%, that sort of thing going forward. So,
Mark, talk for a moment about emerging market debt specifically. I'm going to put up a chart, and what it shows basically as the value of emerging market debt has gone down, actually the ETF investment has not only stayed up, but it's actually even gone up. People seem to be willing to invest. Is this a time to go in, at least selectively, and buy emerging market debt because the prices come down so much?
I think so. I'm bullish now on emerging market debt for that reason. The fact that things have gone down so much and the news is so negative, and that's probably what's being reflected in some of this ETF work. Now, of course, nobody knows the bottom. It's going to happen that we put money in and it goes down further, but we're pretty close to a very pessimistic scenario, which I think is good for emerging markets debt at this stage.
Brian, do you agree?
I keep thinking about 1997, 98. And when Mark's right, you can never pick a bottom. We're going to have some sort of an event that scares everybody. But, at the end of the day, the fundamentals of the world in terms of global growth and earnings still look pretty good. It's not like we're in this dire position. By the way, I just despise this word contagion, okay? I mean, just because it happened in the last recession doesn't mean it's going to happen in this recession or pullback. So please stop that. You're talking about countries that are minuscule parts of GDP that have already had tremendous fundamental problems. And oh, by the way, investors went to the emerging markets and chased them for exactly the wrong reasons in the beginning of the year.
But at the risk of alienating my friend here, Brian Belski, let me use the word contagious in this specific regard, Mark. It's one form of contagion is when people have to sell high-quality assets because they're really losing in riskier assets and they're forced to sell, they don't want to. Does that create a real opportunity because there's some higher quality assets in the emerging markets because people are selling not because of the value of the assets, because they have no choice?
No, that's right, absolutely. And that's the reason why I agree completely with this idea that, you have to pick and choose and do a broad-based stroke about what's happening. And also, I think the other factor here is that we've got to be aware of the opportunities in some areas where people may not be looking. In some of these so-called frontier markets, there are tremendous opportunities. For example, Vietnam. There may be some concern about what's happening in Vietnam because of the global situation, but the reality is that they're going to be benefiting to a great extent because of a lot of the exports coming out of China are going to be coming out of Vietnam. Right. So this is the kind of thing we would look at.